auditing. And then after that, we started with SA 210, which is on agreeing the terms of audit engagement. The engagement letter being issued by the auditor to the client. And very important in the engagement letter, first we talked about the preconditions for an audit. Right, preconditions. Management, only if you accept these conditions we are coming for the audit, otherwise we are not. In those preconditions, one, we had the main precondition, the acceptability of the AFRF, which is being used by the management in the preparation of the financial statements, and whether the AFRF is acceptable to the auditor. So if an Indian company is preparing financial statements as per accounting standard schedule 3, then that is an AFRF, which is acceptable to the auditor. And once the AFRF is acceptable, then 5 other preconditions. Okay, management's responsibility, preparation and presentation of financial statements in accordance with the AFRF, design, implementation and maintenance of internal financial controls, then to provide the auditor with all information of which the management is aware and which is relevant for the audit. Any additional information which the auditor would require from management, those charged with governance, and unrestricted access to persons within the entity from whom the auditor considers it necessary to obtain audit evidence. Right, so those were the preconditions. After the preconditions, we talked about the contents of the engagement letter divided under 3. The principal contents, the additional matters, and the when relevant additional matters. Principal contents, the objective and scope, the responsibilities of the auditor, the responsibilities of the management, the identification of the AFRF, and the anticipated or the expected form and content of the report. Then when the relevant additional matters, arrangements concerning the involvement of the branch auditors, internal auditors, auditors expert, predecessor auditor, auditors liability, working papers, and any further agreements. And additional matters in the engagement letter, elaborate on the scope of audit, unavoidable risk that some material misstatements may not be detected, composition of the audit team, audit planning. Then auditor will require written representations. Management will inform the auditor of subsequent events. They will provide the auditor with the draft financial statements and other information. Then how the fees are going to be charged and a billing. Then the audit process is subject to peer review and also the acknowledgement of the audit engagement letter. Then limitation on scope imposed prior to acceptance of engagement. Auditor may decide not to accept only. After acceptance of engagement, management is telling from tomorrow don't ask any information regarding inventory. Yes, ask the reasons, the circumstances which necessitated the change. It may provide a lower level of assurance because of which the auditor is unable to obtain sufficient appropriate audit evidence. One, in that case, qualified opinion or disclaimer of opinion, or he may also decide to withdraw from the engagement. As such, for a recurring audit, you are not required to send a new engagement letter for each period. But there are circumstances which warrant the auditor to send a new engagement letter for each audit. And 7 changes and 1 misunderstanding. Change in management, change in ownership, change in nature and size of the entity's business, change in AFRF, change in laws and regulations, change in other reporting requirement, change in the terms of engagement, or any misunderstanding with the client as to the terms of engagement. AFRF is unacceptable, say German GAAP, but it is required by law regulation. That is why they are preparing. So it says, auditor, you can accept such an engagement, but 3 conditions. 1, you will not use the phrase true and fair. Then what phrase is he going to use? Prepared. Then after that, management will provide additional disclosures in the financial statements, and auditor will also make additional disclosures in the audit report. Then